Hi, I'm Dinesh, co-founder of Dollars and Cents. On this episode, we'll be discussing the Forex market. While doing research, I was reminded that the Forex market is the single largest financial market in the world with a daily trading value of $7.5 trillion in 2020. From what I can tell, this doesn't even include the foreign currency exchanges we make when we travel. So the overall Forex market can be substantially larger and one that many of us already participate in leisurely. For anyone interested in investing and trading though, it's probably a wise idea to understand and learn more about the Forex market and how it works. That's why I'm really excited that we're spotlighting it in the first episode of our market series. Our industry insider perspective for this episode on the Forex market will come from Kelvin Wong, Senior Market Analyst at Oanda. Thanks for joining us. And for those of you who know Dollars and Cents, you'll recognize another familiar face, Timothy Ho, co-founder and managing editor of Dollars and Cents. Okay, let's first start with understanding what the Forex market is. Can you explain in layman terms what the Forex market is?
Forex is basically short form for foreign exchange. So think of it this way. Whenever we go to a different country, we have to pay in foreign currencies. The thing about foreign exchange is that it's always you always pay for one foreign currency in another currency. So from a Singaporean point of view, we usually pay for foreign currency using our Singapore dollar. So that's how the Forex market works.
So apart from traveling, we obviously have traders in the Forex market. So I'm guessing what is the difference between the spot rate that we see at money changers versus the CFD rates that we see on brokers such as Oanda?
Yes, precisely. There are actually two forms of way of trading FX. One is via the spot FX market, and the other form is using Forex exchange CFD, a contract for difference in full, like a product which Oanda offers. So basically what is a foreign exchange CFD is actually a derivative based on the spot FX rates traded on margin, which is leverage.
Okay, so Kelvin, you have 15 years of experience today trading, providing market research and analysis on the Forex exchange, but also stock markets and commodities. But you obviously had to start somewhere, all of us do. So why did you want to decide to learn about the Forex market, and start trading in the first place?
What kickstarted my interest on the Forex exchange market is during way back then in 1997 Asia financial crisis. There was actually a speculative attack on the Thai baht to the fixed exchange rate due to what I call that mispricing of Thailand's fundamentals against the currency. So what's surprising over here is that yes, the attack took shape and actually have a negative spill-on impact on the Asia stock index as well. So Asia stock indices fall quite a fair bit together with the bond price. As a knowledge over here is that even though, let's say, if you are an investor in the stock market, you also got to be mindful of what's going on in the FX market that could eventually indirectly has an impact on the future potential movement on the stock market as well.
I think whether we realize it or not, many of us are already obsessed with foreign exchanges, FX rates. It's always national news whenever the SGD moves against the Malaysian ringgit. Everyone is glued onto the screens. Whenever we go to the money changer itself, we never get that best exchange rate that we read about. There's always a difference. How does this difference come about? Especially when trading on platforms like Oanda versus looking at the exchange board at the money changer.
Yes, precisely. So in a nutshell, right, Oanda actually offer a tighter spread. So we actually offer CFD as a derivative based on the spot FX rate, which is the most competitive rate in the FX market. Versus money changer, you realize that they have a wider spread. Why? Because at the end of the day, for money changer, there's a lot of overhead costs you got to consider, like the rental of the shops where the money changer operates. So look at the example of the euro dollar, means euro versus USD. So they're actually trading in 4 decimal places. So for euro dollar, it's quoting in 4 decimal places. So one pip in euro USD represents 0.0001 US dollar.
30, so 0.0001.
One, yeah, so it's 4 decimal point.
Okay, so in general, I guess currencies tend to be quite stable, right? Only moving small decimal places. This is good for stability of the country. Also good for international trade, for travelers and traders. But when it comes to trading forex, traders need volatility to profit, right? So I think this is the two discrepancies between the market participants in a way, right? So I'm just wondering, how do traders, especially forex traders, find trading opportunities and benefit from the market?
So as we know that FX CFD actually get trade on margin with leverage. So instead of paying up the full capital, we actually pay a small fraction of that particular instrument. So even though we mentioned earlier on that FX movement on the average move like maybe 1-2% per day, but if you based on leverage of 5%, that means you actually magnify by 20 times.
No, I think I just want to add that I think from a central bank perspective, having currency volatility or fluctuation is actually not in their interest because generally speaking, central banks or government want price stability. But I think what Kelvin said is correct, right? Which is that because of leverage, that's why there's this perception that forex trading could be risky.
And I also think, you mentioned, the major central banks in the world, right? The Bank of Japan, the Bank of England, Euro, and also the USD, with the Fed making announcement. So there's so many markets that we have to pay attention to, and the forex market actually is a 24-hour market during the work week.
Yeah, precisely.
So I'm just wondering, how do traders look at the time zones and how do they manage their trades?
Yeah, sure. So I think we can actually discuss two aspects of it. One is looking for opportunity at what time zone to trade. And secondly, using the current modern day electronic trading platform, which ONDA offer. There's actually various automated orders that traders will actually help them to actually access the market given our busy daily lifestyles right now. So let's first talk about the time zone, the tradable time zone first. Yeah. So as we all know over here is that Asia, we are pretty much fortunate living in Singapore because we kind of overlap in three major time zones, which is the Asia time zone, the European time zone, the UK time zone, and the New York time zone. So we could actually look out for such such trading opportunity during this overlap of this London time zone and the New York time zone. So I think the next one we can touch on will be the automated trading, we call it features in modern day trading platform which ONDA offer. So let's say, for example, if you want to monitor a certain price level that you have on the euro dollar, let's say you want to set a price alert that, hey, if euro dollar hit 1.1040, you can just set it without keep on looking at your handphone or your screen, automatically into your laptop or even your mobile phone using the mobile trading app. So you set this order once this euro dollar has been hit this your predefined order, it will actually pop up a notification. So this is what I call price alert. And on the other hand, over here is that some traders will actually look at set predefined orders. So the first one I like to discuss is limit entry order. So think of a way that, let's say, example, if one particular trader has a bullish view on the euro dollar, that means they expect euro dollar to appreciate against the USD. So I can just preset this limit entry order into this trading platform at 1.1030 instead of buying exactly right at the market right now, which is 1.1050. So then the good thing over here is that how long do you want this limit order to last? Okay, so let's say, for example, there's one thing that's called good till entry. That means if you click this option, it will actually remain there forever until the entry is being hit.
Okay, so another big component of trading, is that we never actually own the physical currencies that we want to buy and sell on the platforms anyway, right? So how do we keep track of our profits and losses, given that they're always in different currencies?
Let's talk a bit about how profit and losses being determined if you're trading the FX market. So let's say, for example, if you are trading Euro USD, that means Euro is on the left side, USD is on the right side of the trade, Euro/USD. So the left side of the currency quote is always the base currency. The right side is the variable currency. Yeah. So it's always on the right side, your variable currency. This is where your profit and loss is being defined or determined as. So let's say if you are trading Euro USD, your profit and loss will be in USD. Yeah. I think one more order we can actually touch on, which is pretty much crucial, is called the stop loss order. So stop loss itself, right? Yes, it's an order. We preset it in our platform. So let's say, for example, I give an example. Let's say we have a bullish bias on the euro dollar. So to prevent us, if our view is wrong, we got to get out of position. That means that is our stop loss. So now the key thing over here is that most of us assume that once we set our stop loss, we go to sleep, everything is fine. Market open, we see 20 pip loss. But how come when I open the screen overnight, instead of 20 pip loss, I see 50 pips loss?
Well, hopefully we see a profit. But in case it was a loss.
Yeah, so what is because the key thing about FX market, don't forget, there will be volatility, period of volatility, period of liquidity getting very thin, and this mindful about price gap. So price gap tends to happen over the weekend because FX don't trade actually 24/7. They actually close on Saturday and Sunday. So to prevent this kind of circumstances, right, some brokerage trading platform like ONDA, we offer a guaranteed stop loss. That means this guaranteed stop loss, we set it at 1.1010, will be guaranteed. But we need to be mindful that there'll be a small premium on it. And this premium will be charged provided the stop loss is being hit or activated. Yeah.
Since forex traders are expected to go in and out, quite regularly, cost will naturally be a big factor, I'm assuming, because they do a lot, multiple trades, many different trades.
Yes.
So what are the different types of costs associated with trading?
So we're talking about actually main two costs involved in we call it CFD FX trading. So the first cost will be the spread itself, which is rather thin, because based on CFDs is actually a derivative based on the spot FX rate. So the next component that we've got to be more aware of is the carry cost. Let's say if you hold your position overnight, more than 1 day. Okay, so this is where the carry will start to come in. So this is where the lending rate and deposit rate comes. So let's say if you long a currency, that means you buy euro, you'll be entitled to euro denominated deposit rate. Something typically that you deposit euro dollar in a short-term banking account.
In the interest rate.
The interest rate,
Yeah, correct.
But like I said earlier on, in order to buy this euro, you got to fund it using USD.
Yeah.
So in fact, USD will be like your funding currency, which will be tied up to a lending rate that you got to pay back
Yes.
to the bank, in a way to the bank. So this particular lending currency over here will also be determined how long you open this position. Let's say you open for 3 days, right? So during these 3 days over here, what if the lending rate on the US dollar is more than the deposit rate on the euro dollar? So this is where you get a negative carry. So traders sometimes got to be mindful that if we decide to hold a position for too long and that particular currency lending rate start to appreciate, it could actually eat up eventually to our actually FX appreciation or depreciation, depending on if you are looking at the long side or the short side of the trade. Yeah.
Being in the industry for as long as both of you have, I'm sure you get to speak to many traders. What are some of the characteristics that you guys see, that determine that this trader will be successful in the long term?
A lot of people are drawn towards retail trading because they want to make profits from the trades. But it's actually not so easy to be a consistently profitable trader. One thing that a lot of new traders don't realize is that, sure, you want to be profitable in your trade, but what typically happens after that is that when they try to increase their trading size of the trade, and then they suffer the loss, then that's where they bust their account, and then they get very discouraged, right? So I think for anyone who's thinking of learning how to trade, I think what's very important is really building that base skill first, learning the knowledge. Of course, you can't just learn by reading or watching YouTube videos like this. You have to also try your trades. That's where a demo account might be useful as well.
All right, thanks guys for explaining the forex markets. It's been a detailed, insightful session. Some of the main takeaways that I found out was, you have to be aware of your risks. You have to have risk management strategies. New and aspiring traders, like what Tim mentioned, they may be attracted by what they read, watch, hear online, but it goes both ways. Like we mentioned, you can earn a big amount, or you can also lose a big amount. And one of the ways that we did mention, when learning to trade, we can use a demo account, develop a trading plan, see whether it works, and then take it into a real world, real money kind of trading strategy, right? Okay, thank you guys.